Hello traders, would ever you trade again if you lost $120,000? Well, your answer might be both yes and no depending on numerous factors. The year 2015 remains memorable in the history of Forex trading. Join us in this video as we take you through the biggest flash crash that ever happened in Forex. In early 2015, Forex traders experienced one of the most dramatic events in the history of the Euro-Swiss franc currency pair. This event, which was triggered by the Swiss National Bank, SNB, led to the biggest flash crash ever seen in Forex trading. Understanding what prompted the SNB to make such a move and also considering the possibility of a similar event occurring in the future is essential for every Forex market participant. The Swiss National Bank's action in 2015 was an extraordinary move that took the entire market by surprise. Central banks typically aim to maintain price stability while taking into account economic developments, but in this case, the SNB's intervention caused billions of dollars in losses. Switzerland is one of the few European countries that have retained its currency, which gives the SNB significant influence over price stability and economic development within the country. As an export-oriented economy, Switzerland benefited from the appreciation of the euro against the Swiss franc in the years that followed the introduction of the euro, which led to record levels of exports by October 2007. Typically, by October 2007, the euro had appreciated against the Swiss franc, reaching a value of 1.6829. However, the global financial crisis, which began with the US mortgage crisis in the second half of 2007, led investors to seek safer assets, including the Swiss franc. This movement caused the franc to appreciate significantly against the euro, with the euro losing up to 36% of its value against the CHF by September 2011. This appreciation negatively impacted Swiss exports to Eurozone countries, which accounted for around 70% of Switzerland's GDP, leading to a downturn in the economy. By August 2011, with the euro-Swiss franc exchange rate approaching parity at 1.0365, the SNB decided to intervene. In September 2011, it pegged the Swiss franc to the euro at 1.2000 to support its exporters and economy. The exchange rate immediately stabilized around this level and remained there with only slight fluctuations in the following years, which helped Swiss exports and appeared to be a successful strategy. To maintain this exchange rate, the SNB had to print large amounts of new francs and introduce them into the market to weaken the currency. By the end of 2014, the total foreign currency reserves held by the SNB had grown to a staggering $480 billion, which was about 70% of Switzerland's GDP, with the euro accounting for more than 45% of this sum. However, in 2014, the euro itself depreciated significantly against other currencies, which also affected the Swiss franc. As a result, the value of the foreign exchange reserves held by the SNB decreased rapidly along with the euro's depreciation, and criticism of the SNB's policy grew significantly. Despite these challenges, the SNB continued to maintain the euro-Swiss franc exchange rate at 1.2000. Forex traders exploited this situation by opening long positions whenever the price approached 1.2000, expecting that the SNB would not allow the price to fall below this level. By the end of 2014, the ratio of long to short positions on the euro-Swiss franc pair was an extreme 71, reflecting the traders' confidence in the SNB's policy. On the 15th of January, 2015, at 4:30 a.m., the Swiss National Bank announced it was ending the peg to the euro, causing an unprecedented panic in the market. According to FXCM, one of the largest Forex brokers at the time, major liquidity providers withdrew virtually all liquidity within a minute of the Swiss National Bank's announcement. The situation became chaotic. At one point, there was a difference of 5,382 pips between the quotes of two liquidity providers, with one quoting 1.1078 and the other 0.5696, but the trading volumes were virtually zero. There were also instances where quotes from the same liquidity provider differed by 4,500 pips within seconds, first quoting 0.9550 and then 0.5000 a second later. The market did not return to normal for about an hour, but by then, traders and brokerage firms were already counting losses that ran into the hundreds of millions of dollars. The Swiss franc appreciated by more than 20% in just a few minutes, with the price eventually settling slightly below parity. The lack of liquidity led to extreme losses for traders who had open long positions, as many ended up with negative balances and owed their brokers substantial amounts of money. This was largely due to the high leverage commonly used in Forex trading and the failure of stop-loss orders to find counterparties in such a volatile market. Margin calls from brokers also failed to function correctly. The financial impact was severe. FXCM reported losses of $225 million and saw its share price plummet by 90%. Citibank reported losses of $150 million, while Alpera UK and XL Markets went into insolvency as they could not cover their clients' losses. The day after the event, client losses in the Forex market were estimated at more than $400 million. The Swiss National Bank itself also suffered significant losses due to the franc's appreciation, reporting a loss of 47.2 billion francs on foreign exchange transactions. The stronger Swiss currency led to a 2.6% drop in exports and negatively impacted the tourism and retail sectors. The reasons behind the SNB's decision are still debated. Some believe that the situation had become untenable for the SNB, given the expected launch of quantitative easing by the European Central Bank, ECB, the upcoming elections in Greece, and mounting pressure from interest groups dissatisfied with the ongoing situation. Regardless of the exact motivations, the 2015 flash crash serves as a stark reminder of the potential for sudden and extreme market movements. Although such events are rare in Forex trading and the likelihood of a similar occurrence in the near future is low, traders must always remain cautious. Typically, it's recommendable to always consider the possibility of sudden events that can move the market more than anticipated. Proper risk management and discipline are fundamental whenever opening a trade. We finalize by highlighting the following. By understanding the events that led to the biggest flash crash in Forex history, traders can better prepare for and navigate the uncertainties inherent in financial markets. While the exact circumstances of 2015 may not repeat, the lessons learned from that crisis emphasize the importance of vigilance and sound trading practices in an unpredictable market environment. On behalf of Sen Securities, I'm Erica Trina. Always remember to trade wisely. Thank you.